Today is Monday, October 2nd, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Good morning. Steve, let's start with the grains today. Last week, the USDA estimated September grain stocks and final U.S. wheat production. What did they say and how did the market react?
I think first they estimated the wheat crop actually a little bit bigger than the last report and also bigger than the average trade guess. They also estimated the wheat stocks higher than expected. Corn stocks a little bit lower than expected, but on the bean side they lowered the stocks more than expected. So the market reacted positively in the beans. Funds bought beans, meal, and oil. They acted negatively in the wheat, and they sold wheat off.
Any reaction whatsoever in corn?
Not really. I mean, it was a fairly quiet trade. I think, though, when you look at the markets, though, they feel heavy today. I don't know if it's just that all commodities are down today or if just we're in the middle of harvest and it's hard to rally.
Talk about harvest. How about an update on harvest? How far along are we and what are the farmers reporting as yields versus expectations?
Well, we're about 25% done, which is near normal. Farmers are reporting yields that are better than expected given how dry it's been the month of August and September. And so far, they've been good sellers initially of the beans as they came off the fields. Over the weekend, they were good sellers of corn. And so it just kind of feels like on October 12th, the government really is going to bring the crop numbers down. And as long as the farmers are selling, it's weak on the cash and weak on the futures price.
Can you speak to the current managed fund position in the grains?
The funds are long about 30,000 beans. They're short about 120,000 corn and about almost 70,000 wheat. And those positions historically are kind of small. They can have bigger positions than that, especially in corn and beans. So we'll just kind of watch as we go through harvest, looking at the demand numbers, watching South American weather, watching the Russian weather to see if they're going to either add to those positions, move them around, or just how they're going to go into the end of the year.
Setting the fundamentals aside, what are the technical signals suggesting in the grains?
Today is a weak day. November soybeans are trading below their moving averages, which suggests that we'll go back to the 920 area on the November futures. This was after almost testing 980 last week. In the corn, we're still stuck in this range, but we're at the lower end of the range. If we take out 350 on the December, we'll go down to 340. And it seems like that price, the farmers stopped selling, and we find some support. In the wheat, we're also back below the moving averages, taking back most of the gains that we had. It looks like now we're going to go back and test 420 in December Chicago wheat.
Are there any strategies that grain traders and farmers should be considering right now or in the near future?
It's interesting that where the farmers are selling cash corn, they're replacing it with calls. So it's just like the March calls. Volatility is low. They're not paying for a lot of premium, but they're just kind of replacing what sold inventory in case there's a South American problem or in case the market does rally back up. It's interesting that one private group came out and said, let's sell some cash. They sold 10% of this 17 crop. They sold 10% of the 18 crop. And they sold 10% of the 19 crop. And that's pretty bearish bias because usually this is the time of year when we make lows, both in the futures and the cash market. It's interesting that Hightower came out today suggesting buying the 990 Jan soybean call. They think that the report that came out last week, the dry weather and the demand underneath the market by Chinese could actually eventually push us over $10 once the harvest is over. And it's interesting that we have on October 9th and October 16th, some seasonals that come in and say we make bottoms in the corn and bean market those days.
I think it's a good strategy as well for farmers to look at. I mean, the re-owning of your crop after cash sales helps. It's a hedge basically against remorse. The market rallies and there's a lot of uncertainty still in regard to the South American crop. So
if you have a tight balance sheet, it helps you pay the bills, but replacing your inventory with what we consider cheap calls because the volatility is so low.
And let's turn toward economics. U.S. economic output grew at 3.1% annualized rate in the second quarter. That marks the best growth rate in 2 years. How did this affect the outlook for Fed policy?
Well, basically, it reinforced the view that the Fed is likely to raise interest rates at their December 13th meeting by another 0.25%. That also is in keeping with our belief that the Fed will be raising then. So nothing has really changed. The Fed is on track to raise, and I think there'll be at least 1 or 2 more rate increases in 2018.
So if the Fed Reserve is on track to increase interest rates again in December, how can stock index futures continue to advance with the Fed tightening credit?
Well, basically, interest rates are just still too low. We've had several rate increases, and yet stock index futures continue to advance. Don't forget we have interest rates overseas that are still very low, and in fact, in Europe, there are negative interest rates in a lot of countries. So rates are low enough, in spite of the Fed rate increases, to sustain the bull market. There's a lot left to the upside.
So even 2, 3, 4 more interest rate increases, if we're talking about 0.25%, we're still historically low in interest rates.
Absolutely. This bull market can sustain several more rate increases and still be a bull market.
So doesn't this fly in the face of the rule, don't fade the Fed?
It absolutely does. And if you use that rule to trade stock index futures, you would have been short for almost 2 years in the indices when the Fed first started raising rates in December of 2015. So don't fade the Fed. Worked for a while in the past. It's not working now, and I don't think going with the Fed as far as being bearish will work anytime soon.
So gentlemen, anything else hot right now? I mean, is there anything going on in the metals or in the energy markets that is noteworthy?
Well, the metals were substantially higher several months ago. In the case of the gold market, we rallied about $152. Since then, though, with the likelihood of the Fed raising rates in December, there has been some long liquidation, with the gold market giving back about 1/3. But I think this is a base area, and I think we'll ultimately start to work higher again. Inflation is still with us. It's going to be a problem, and I think inflation will accelerate globally. So the main trend is still higher in the gold, even though we have seen some of these some very good gains given back recently.
Steve, energies, we rallied a little bit in the crude last week. Seems like we're coming back down, hovering at this, right around this $50 level. I guess production back online up in North Dakota, the fracking's back in play. Any news out there in regards to
I think
energy
the
prices?
energy market is looking at 3 basic fundamentals. Number one is that there's this attempt by OPEC to lower production, and that seemed to help the market rally, at least over the $50 a barrel level. The second thing is globally the economy looks like it's improving, but we had reports last week that by the year 2020 China wants to have complete electric cars, no gasoline consuming cars. And we also see that here in the United States, kind of that movement. And there's already talk that in some European countries they're going to ban combustion fuel automobiles. So, I mean, all those factors might be working against the energy market. And then, as you mentioned here, fracking, when we get prices up, the rigs accounts and the fracking goes up, and that tends to keep us in this trading range that underneath the market, maybe it's a lower world production and better demand, but above the market is all this move away from automobiles using gas.
If automobiles go all electronic, obviously that changes the demand picture for crude oil in a big, big way.
Yep.
Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.